Yeah, I put on a real shirt today for this.
Yeah, me too.
Yeah.
We got the open collar thing going on.
You got to unbutton
Yeah.
one button lower, and you're like, yes.
Oh yeah, we're a man of leisure.
Yes, we can be.
Indeed.
We can be. Are you recording this? You are recording this. Fucker, delete that.
Hello.
Hello, hello,
Oh,
hello.
look at that.
It says default microphone here. Maybe I'll do it too. How do I? It doesn't let me change.
Don't change, Andrew. You're perfect the way you are.
Thank you, sir. I love you too.
Hello, barbarians, and welcome to the third episode of the LLB podcast, Low Level Barbarians, from Asia on Asia, with debate and discussion on trending topics with our usual host, the man of the high ground, Dave Chang.
Hey guys.
Chang, the information super connector.
Hello.
Andrew G, the master debater. And me, Alex, typically your host of EOA. For the first topic today, we are going to talk about the AirAsia SuperApp. So there's a clear backstory. AirAsia is the largest low-cost carrier in Asia, probably. It's top in the world. They are trying to build a super app, which includes teleport, their logistics arm, rideshare. I'm not sure if they made investments there, but they've talked about it publicly, plans there. Food, they've bought Gojek Thailand and Deliver Eat in Malaysia. And they have BigPay, which is their financial arm. I think the story is in two parts. Their core business recovery. So it's very clear that during COVID, their business tanked. No one's flying. They had to recapitalize, do some interesting stuff to finance their current operations. So that really depends on the duration of COVID versus how well capitalized they are. And then for the second part, for the super app, their ability to execute on a tech-driven business. It's clear that investors only care about their core business. Share prices have been depressed, but if you look at the comparables like Ryanair, Southwest Airlines, all of these stock prices have made a full recovery. Of course, they kind of dipped back because of the Delta variant. But it's people are more bullish versus where Asia is in terms of sentiment. And if you think about their super app, right, that depends on their technological know-how, if they have enough money to build it out, competition, talent retention, and the culture around that, and also regulation. So for me, the bull case, right, ceteris paribus, despite very complex cap table structures, the opacity of some of their companies in the region, along with, nothing changes with Tony's ability to manage all the politicians and getting licenses for the airports. I think there's a very bull case on the pure TAM growth, the total market that grows as travel recovers and Asia becomes more middle class and people more travel. And that's a very big profitable machine with a big brand moat around it. So people with deep value investing long term, they are pretty bullish on this story. And I think that bodes well if this recovery does happen and COVID doesn't kind of kill the whole thing, where there's a good cash cow machine to kind of fund their actual super app ambitions. But of course, the bear case is that COVID persists longer. Their cap tables is too complex. The financing is just too aggressive. They collapse. They have to do Chapter 11 or whatever the Chapter 11 is in Asia. Or they're not competent enough to build out the super app that they want to build. They can't retain the talent or make it happen. So thoughts, anyone? Dave, you have an opinion on AirAsia, I believe, after reviewing their Q1 results?
Yeah, I do. I think, as you correctly pointed out, I think it's impossible to talk about their super app ambitions without talking about the core airline business. And as everyone is aware, obviously, COVID continues to have a deep, depressing impact on the airline industry in general. And I think it behooves us to go over some of their headline stats, right? So the Q1 21 results just came out, I think 2 weeks ago. And I think there's some really interesting things in there, right? So the Q1 combined revenue was only 116 million ringgit. So for those of you in America, that's like a 25, 30 million US dollars, right? And you have to match that against their net operating loss. So airlines, it is a little bit tricky how the accounting and financial reporting works for airlines. So basically what happens is your leasing obligation. So AirAsia is an asset-light business in the sense that they don't own their planes. They essentially lease their planes, and that's how they work, right? So So the way that it works in financial reporting is the leasing obligations and the financial payment obligations for those leasing contracts don't come out of EBIT. So if you look at their pure EBIT, their EBIT is actually not that bad. Their EBIT is like, I think, negative 217 million ringgit. But if you actually add, what you really should look at is their net operating loss, and that is a really ugly looking number. So their net operating loss in Q1 2021 was 793 million ringgit, so 200 million US dollars, right? So it's essentially 6 to 7 times what the actual revenue, is. And then so the question really is, okay, so this is a scenario, this is their business performance. How much cash and how much runway do they have, right? And I did a bit of back of the envelope math. And as of Q1 21, they had 447 million ringgit in cash equivalents on their balance sheets. They had put out a private placement for about 470 million ringgit, which was closed in Q1 2021. So it's unclear to me whether that 470 million private placement was accounted for in their cash balance at the end, but let's just say that it's not. So we just add that to their cash balance. So that gives us approximately like 900 million. They're also then out doing a rights issue, looking to raise another 600 million to 1 billion ringgit, and then they have another 1 billion in loans, in debt financing that they're trying to raise. So all told, we're looking at somewhere between 2.5 to 3 billion ringgit in cash for a business that's burning 800 million a quarter, right? So I mean, everyone here can do the math. That gives you, I don't know, somewhere between 3 to 4 quarters of runway, assuming these conditions persist, which to me is pretty thin. So again, that's just their core business, right?
Yeah.
And if we look at their super app business, so their super app business, AirAsia, it's called AirAsia Digital. That's the umbrella for this entire thing. And they actually did break out the performance of AirAsia Digital. You have to dig into the Q1 reports, but it's on like page 23 for those of you who want to actually go look at it. And as Alex pointed out, they basically split up into 3 segments. AirAsia Digital is Teleport, which is their logistics arm, the AirAsia Super App, which is sort of like food, e-commerce, rideshare. It's a catch-all. And then they have Big Pay Group, right? And then they have some other AirAsia digital entities that they bucket under. They're very, it's not clear what those actually are, and they're not really large line items anyway. So the super app is doing, in Q1, they did, looking at this, around 120 million ringgit in revenue, right? But like almost all of that, so 93 million of that 120 is teleport. So that's teleport, still by far the largest part of that business. And actually, the teleport business shrank year over year. So in Q1 2020, it was actually 150 million ringgit in revenue. So it's actually taken a substantial haircut, and that's mostly from the drop in international freight. And I think the reason we're talking about this now is the digital business, which is their the Air Super App, segment of the digital business, which is what we're sort of initiating this conversation. This entire business only did 10 million ringgit in revenue for the entire quarter, and that is up from 6 million year over year. So, to me, these are pretty anemic numbers, and the way that I'm sort of looking at these acquisitions that the group is doing is essentially he's trying to cobble together revenue from all these disparate sources to create a more convincing investor story for when he tries to shop it out to the mainstream investors or the public markets. So in general, I guess what I'm trying to say is like this seems to be like a very high wire act that he's trying to pull off. Like, I mean, Tony Fernandez is obviously a very talented businessman, very skilled entrepreneur and operator, but trying to keep his core business afloat while at the same time simultaneously sort of showing revenue growth on his digital business, it just seems like it's a lot of balls to be juggling at the same time. And I think that would be that's a very, very difficult task for any CEO to manage. So I would be very impressed, I guess, if he manages to pull this off.
Hey, out of curiosity, how do they recognize revenue? So you mentioned about teleport, and you mentioned about super app, and how does the revenue get recognized? What exactly is the teleport revenue?
So I didn't dig into the Q1, but as I understand, Teleport is actually mostly international logistics. So it's like, from what I believe, it's like 70/30. So 70% is international air freight and 30% is like local last mile stuff.
So essentially, it's like an Aramex. So I could approach them as a 3PL, and I could send my parcels to them, and they'll fly it across the world, essentially.
Well, I mean, for example, like we do use AirAsia for one of our Korean beauty businesses that does
Okay,
international
interesting.
freight
Yeah,
forwarding. We use they're one of our providers, right? Or we use some of their capacity for our transport. Yeah.
So basically like a freight forwarder.
Yeah, it's a freight. It's a international freight. So like a
logistics
value.
business.
Yeah, it's a logistics business. So asking
Okay.
for like a 10x revenue multiple on a logistics business, or on a super app that's primarily a logistics business, seems to be. You need to be a very good salesman to do that.
What's also fascinating is that you mentioned they lease their planes, and Janka and we were talking about this earlier off the podcast. Was that because most of their leases are small planes and small flights, their actual cargo space and utilization is probably very low compared to a big long haul fleet who actually owns it and gets an actual return over time as the assets depreciate, right?
Yep. And also for larger planes, it's I mean we tear the seats away. It's actually a fairly significant amount of space that you can use for cargo, and for the smaller planes, so we did some work for one of the Indonesian airlines a few years ago to look at, I mean, how they can turn their excess capacity in the cargo space into a logistic company. But the thing is that it's quite hard. I mean, you really don't have much space to do it big. And I think the point about freight forwarder is essentially a travel agent, right? So basically, I think for AirAsia's point of view, they can connect you with I mean, they can book their own sort of space for you, but probably they can do third parties as well. So if we say that they're like a travel agent, I mean, if they recognize revenue as what, I mean, if you sell you I don't know 10 million dollars worth of like shipping charges, and do they recognize this 10 million as revenue, or do they recognize their commission, which is probably, I don't know, 1.5 or 2 million as revenue?
So you're making a GMV argument, right? If
Yeah, kind of, yeah.
GMV versus, I mean, because that's if they're trying to build a super app, they're going to try and raise on GMV. But if they're a public company, they have to report actual revenue first, in the
Yep.
IFRS gap kind of way. Right?
Yeah. I mean, for me, it's just when I look at revenue numbers, just sometimes it's difficult to understand exactly what they're looking at as revenue,
Yeah.
right?
Yeah.
How is Fernandez as a person? I mean, I've watched him on TV. I've listened to him on Clubhouse. I've not seen him in person, and obviously, recently there has been a bit of news of him probably not paying attention at the internal town hall, and it sort of went viral. And then you have Tech in Asia writing like reports saying that, oh, is the culture toxic? We spoke to ex-employees, the current employees, etc., etc. We got someone who was telling us on our WeChat platform, so probably someone from China, but working either in Malaysia or Thailand. He said, Tony Fernandez, look, I mean, the problem that you see on a town hall is the list of his problems, and actually the whole company finds that person who got ridiculous annoying, but they just didn't have the right way to deal with her. And he said Tony's biggest problem is that he drinks while at work. So this is something that I can't really verify.
Yeah, I mean, only anecdotally, all of us have friends who somehow been pulled to AirAsia one way or another
Okay.
from one of their many arms, right? And I only know that retention, like I'm just looking raw numbers, right? Retention, they don't last long. 1 year, 2 years. So there is an actual retention problem. And that's one of the points I mentioned, right? Ability to retain tension. And that speaks to their super app ambitions. You need to retain that talent to, if you want to build long-term. So that's what I could note there. I don't know him personally. I've never spoke to him, so I can't say.
Yeah. I mean, I think there's a couple ways to think about this question, right? I mean, I think if you're trying to value a company, there's usually two ways to do it, right? One is like based off the strength of your P&L and your balance sheet. So that's just a straightforward, like numerically driven exercise. You do discounted cash flow, assets, whatever, right? And then the other way is sort of like a more narrative driven approach, which we've seen in the US, like Elon Musk for years basically built his business and fundraise on the back of sort of like, his personal story and his ambitions. And it was a beautiful story, right? Everyone wanted to be part of it. And I think this is going to be a unique challenge for Tony Fernandez in the vis-a-vis. He is sort of known as he's marketed himself as sort of this superstar entrepreneur of Southeast Asia, and I think that's true. I mean, I think that give him where credit is due, or do where credit is given. He's actually achieved a lot, but I think like if he's trying to go via a SPAC listing in the U.S. He doesn't have that same brand connotation in the US that he does in Southeast Asia. I can tell you right now, if I talk to any one of my friends and that's American, ask them, do you know who Tony Fernandez is? And
What makes you think he wants to do a listing in the US?
I think it's publicly stated he wants to do a SPAC listing in the US.
Really?
Yeah.
Sorry, Dave. Why don't you finish what you were saying?
No, I was just answering your question. So so there's multiple headlines or multiple articles that said specifically he's looking to do a U.S. listing for the U.S. SPAC listing for the digital ventures businesses. So that's where I'm getting that reference point from.
Got it. So my take on this is, look, at the end of the day, yeah, so I feel like as a group, we seem to waver on this quite a fair bit, right? One moment we're interested in these like narrative driven startups, and then suddenly we become financial experts or looking at it from a numerical perspective. Tony's claim to fame is this, right? He was a music guy with no experience running airlines, and he was inspired by Richard Branson, also a music guy, who then said, I'm going to run an airline. He bought an airline that was 30 million ringgits in debt for a ringgit. Honestly, it was doomed to fail. If you look at what he inherited with that airline, it was ridiculous. And then he figured out how, so he had a bunch of things working in his favor, right? He did futures contracts on oil, did these ridiculous leasing agreements that, did some really high risk bets that paid off because travel blew up in Southeast Asia. And if you think about how it grew, right? If you go to any other emerging market, LATAM, the Middle East region, no one's been as successful as Tony in building like a low-cost budget airline with that many routes and that kind of tight economics. And I think credit to him, not just like, I don't think it was just luck. Like, this guy knows what he's doing. He's able to build that, right? And I think that gives him the confidence to think like, if I've done it once before in a completely unrelated space that I knew nothing about, and I made myself a billionaire, can I do it in other related fields? And think about what he's done. It's not just like a Malaysian company; it's an Asian company. It's a brand that didn't exist 20 years ago, and today it's recognized by a lot of people, not just in Asia, but people who travel into here, right? And 2020 has been brutal to the airline industry and to tourism overall, and AirAsia's probably gotten harder hit than most other companies here, just because they have all these long-term commitments that's going to hit their debt servicing levels and their ability to actually because the way the company is modeled is on all these forward contracts, right? And so what he's doing right now is the same thing he did in the late 90s, which is bet $1 to build something ridiculous that didn't exist before with this forward-looking site. And he's a visionary who's done it once before. Now the question is, can he pull together the right team to do this, right? And so this is where I differ a little bit of what you were saying, Alex. Like, I know churn's been high anecdotally, but to be honest, what's churn at Amazon? 2.3 years, right? What's churn at Alibaba, Tencent, or any of these other fast growth companies? Relatively the same, 18 to 24 months. No one really sticks around for that long in any of these companies, right? Any high performance company, whether it's the BCG and McKinsey of the world, people don't stick around for that long. You go in, you learn, you get out, you do your own thing, or you join somewhere else, right? But the people that are within his core group have been around for years, right? Irene's been there, 15, 20 years from the start. Ben, all the other people that are one level below him. And if you look at the way he's scaling this up, I think the realization was this. So if you think about 5 years ago, Traveloka also wanted to build this super app idea. But the problem with these kinds of travel apps moving into super app space is the DAU MAU for these apps is very low, right? Not a lot of people are using these apps frequently enough for it to be warranted enough for this app to become like a lifestyle daily usage app, right? And so in that sense, some of the decision making has been really smart, right? How do I acquire other players to create high enough use cases, whether it's food delivery, whether it's logistics, and build that back end that somehow ties into some of these other businesses, and then build a layer of an app on top of that so that you get to scale it up. So and the pieces are coming into play, right? He's got BigPay, which is like a wallet slash credit card, prepaid card pay thing. Then you've got Asia for travel. Then you've got the acquisition of delivery, the acquisition of Gojek's business in Thailand. So I think the action is in place right now to sort of do his second play. I mean, maybe third play. First play was music. Second play was airlines, and the third play is super app, right? I think in terms of being able to hire talent, attract the right kinds of capital, acquire companies, he knows what he's doing. The question is, will the financials? I mean, it's still a big bet that he's taking, similar to the bet that he took in the 90s. And if tourism kicks off again in the next 18 months and there's more cash in bank, then this guy's going to kill it, right? But if COVID sticks around any further, it's a last ditch effort. I mean, if I respect and applaud this guy for doing this, like given how shitty the situation is, he's like, I'm going to bet on something else, and if things get shittier in my original business, I have the second thing to bet and push on, right?
Uh,
That's my
Well,
take.
let me just answer. Let me respond to that one point. I was just making a comment alluding to the nature of culture. I mean, your point still stands. People do come in and out at the lower levels. You're right, and you're looking at the core team for longevity, which matters, right? And that points to, does he have someone who could execute on the vision? He's definitely much the sales guy, the marketing guy, right? The branding guy. He admits it in all his podcasts that he talks about. So the question is, for his core team, does he have the Sheryl Sandberg? Does he have the people who execute to make that vision come true? And then also, it's very different. You're building a core team on a new separate business segment, and that points to the question of culture. Then, is the culture sticky enough for a different kind of company? So for the core business, yes, I completely agree. So, and I mean, that's why I'll just respond to that one point.
Let me add a few points. So first, I think the point about churn. So I will never look at it as a factor to determine whether the company is viable or whether it has good prospects, because churn is what you see from outside, right? I mean, what is causing the churn is something interesting, because it could be that it could be the culture is bad and people don't stay, etc., etc. But it could also be because the company is super demanding and many people don't fit. And especially in this region, we know that experienced talent in tech is scarce, right? I mean, so sometimes you have to bring talent who might not necessarily make the cut, but because nobody's experienced, so you don't really know. And quite often that causes churn. I mean, if you look at Tesla, the churn is probably very high. So whether it matters or not. And second point I want to make is about him transitioning from music to airline, and now airline to super app. I think I think there's a big difference here. So airline is essentially operating assets. I mean, you have all these assets, or you lease all these assets, and you get return out of these assets. And he has his marketing experience. He has his own branding. But for airlines, it's relatively easy to find people who are experienced to manage that, because it's a very established business, and lots of airlines were efficient because they were funded by efficient capital, sometimes state capital. So there was no incentive for them to survive for a long time. There's no incentive for them to be efficient. So in terms of private airlines, there has been quite a number of examples of people doing it pretty well. Although the question, I mean, comes to COVID, right? I mean, because it's a private airline, so they probably do not get the state aid for them to survive compared to other airlines. But that leads to my third point, which I think he's a survivor, just like Richard Branson. I mean, I watched the whole live video of Richard Branson going to space, and after that video, I sort of realized why he had to do it so quickly, and especially after you have watched Bezos, because Bezos' technology is far more superior. And but I still look at Branson. He put up this, and it is inspiring. I think some people would be inspired by that to follow this. The last point, which is relevant to the first and 2 points, is about talent. And as we know that this is building something new, and you don't really have that many people who are experienced in this area. So it's about figuring out, I mean, what is right. I mean, and he's probably trying different things to see what works out. You know that for Meituan, when they sort of decided that the initial group buy was no longer, and the grouper model was no longer feasible for the long run, so they internally started about 40 projects and eventually settled on food delivery because it is what worked out of these 40 attempts. So maybe there's something going on at AirAsia as well. They're trying different things to see what works out the best for them. And last ditch effort, at least he's still making an effort.
Yeah, for sure. I mean, I would say, there is the reason why there is a bull case, and I think it's viable as long as the machine returns back. If the core business can continue to grow, it buys time for them to figure it out. Then it's just a matter of all the other fault pieces, can we figure it out then? But like what Dave points out, there's a very precarious time, so it does seem very questionable, and one wrong step could mean everything does blow up. And the other last thing I would add is that I think what a very interesting piece that I heard from this very esoteric show called the Southeast Asia Travel Show. They talked about the actual regulation piece, and there's one case that really puts a big multiple if he maintains his monopoly, is that if the ASEAN Aviation Accord for an open sky policy happens, it means there's free travel, no restrictions across countries in Southeast Asia. And with a monopoly, he then could just reap the benefits of no restriction travels, right? So, and all of this is based off the 1944 Chicago Aviation Accords, which set up the bilateral agreements of how this whole market works globally. So, if Asia can get their regulation piece together, I think he's in a very strong position to multiply that kind of monopoly even further. Any final comments before we move on to the state of VC?
No, I'm good.
Okay, so I think for the state of VC, for me personally, we're going to talk about what's the current state of VC is in Southeast Asia. That touches a little bit of Angel as well, I guess. There's a macro picture, there's a micro picture. But before we dissect into that, I think Dave had a presentation he wanted to share, so we'll let you take over.
Yeah, thanks, man. I learned how to share my screen in between the two sessions. Yeah. So here we go. Can everyone see my screen?
Deck prepared for us.
I have a whole deck. Can everyone see my screen?
Yep.
Okay, cool. So, I mean, let me just walk through this. I'll try and be quick as I can, and we can just, of course, interject and have a discussion afterwards. So anyway, so state of VC. So let's start with, I think, sort of like the headline numbers is really, I think everyone here talks about how the state of VC is booming and there's just a lot more money coming to the market. But I think it was useful for me at least to quantify sort of how much money we're actually talking about. So what I have here is basically this is the amount of capital deployed on a yearly basis in millions of USD. And I apologize, you can't see some of these numbers because of the formatting. Basically for the last 10 years, right? So just to do the quick math to everyone, basically in 2018, 2019, and 2020, so the region has deployed around $8 billion in capital, and that is up significantly from sort of like the earlier phase where we're only deploying about 2 to 3 billion on an annual basis. And I think there's no surprise here that a lot of that is going to Singapore and Indonesia. Actually, those two markets represent the lion's share of investment, right? So that actually maps pretty closely to global venture capital trends. So this is the same graph, except now I've added this yellow mark. So apologize for the audio listeners that can't see this. So this yellow line is the amount of capital deployed in the US. Obviously, the scale is different. It's in billions of dollars, but if you look at the trend lines, right, they're roughly, they're fairly well correlated. And so the question is, what is happening here? Like, why are we seeing this explosion in the last 3 years in venture investment? I think there's a lot of things that we can talk about. We can talk about sort of just how tech is now no longer just a niche product. We can talk about quantitative easing. But for me, it's really about the sources of liquidity. And I have this picture, and it's two things I want to talk about here vis-a-vis sources of liquidity. So number one is this guy. So everyone, for those of you who don't know, this is obviously Masayoshi-san. So if you look at the quantum of capital invested in venture capital, there's this inflection point in 2017, right, where we went from like 3 billion a year to 8 billion a year. And I don't think it's any coincidence that that was also the year the SoftBank Vision Fund 1 started to deploy capital, right? And then the other big like landmark moment or the trend that we're seeing is we're seeing the entrance of crossover funds, or what's known as crossover funds, into the VC ecosystem. So what crossover funds refer to are typically private equity public market investors that are getting into the VC phase. So typically these guys play in public markets or like late stage, very early pre-IPO, but we are seeing them increasingly go downstream, or I guess upstream in the ecosystem. And so essentially what these two examples are showing is the amount of money and the type of capital that's going into the system has fundamentally changed, right? Like 6-7 years ago, 10 years ago, people who were investing in VCs were probably corporations, ultra high net worth individuals, family offices. But as we've seen with SoftBank and some of these crossover funds, now we're getting a new class of capital, which is like pension funds and sovereign wealth funds. So we're deploying a lot more money than we ever have. And just to give you a bit of an example, right? So this is global VC deals by select investors. So these are all typically private equity, public market investors. And as you can see, Altimeter is actually in here. So I told you guys I was on top of Grab. So Altimeter, for those who don't remember, is a SPAC sponsored Grab. But anyway, what this graph is showing is a lot of these private equity guys are really, really scaling up their venture capital participation and their activity in the market. And I think the one to really, really talk about or focus on a little bit is Tiger Global. So Tiger Global is this black line here, right?
Mhm.
So these guys are incredibly interesting. So for as much as like VC invests in innovative companies, the actual VC space in and of itself has actually been pretty stagnant for the last 20-25 years. And Tiger Global is creating like a whole new approach to venture capital. Essentially what they're saying is Tiger Global, for those of you who don't know, they were a private equity. They were managing about 70 billion US dollars
That's fun. But yeah.
in public market equities. And then they started really ramping up their VC activity. Most of it was in India for a while, but as you can see, this is sort of like the number of deals they've participated in. So starting in around 2018, they really start ramping up the amount of deals that they're doing. So they did 52 deals in 2018, 82 deals in 2019, 79 deals in 2020, and like year to date, 2021, they've done 176 VC deals. So that's essentially a deal a day. And they're also raising huge funds. So they've raised in the last 10 years 23.6 billion USD in venture capital for just one fund. And to give you some context, in 2018 or 2017, the US, all the VCs combined raised 23 billion US dollars. So these one asset managers are raising and deploying at an incredible velocity. And it's incredibly interesting what they're doing. Essentially what they're saying is on the entrepreneur side, they're giving super fast close. They can close within a week. They're giving incredibly favorable rates. They don't take board seats. They don't take control. They let the entrepreneurs do their thing, and they're giving you above market valuations. So as an operator, why wouldn't you take that, right? And then on the flip side, as a product for LPs, what they're essentially doing is they're creating an index fund of late stage tech, right? So if you want exposure to tech companies that have yet to go to market, go invest in Tiger Global Fund and you get access to all of it, and that's an incredibly compelling product. So I think what they're doing is incredibly innovative on both sides of the equation. So essentially, what that's doing is it's really, and we're seeing this in Southeast Asia, right? It's inflating deal sizes at all stages, right? So 2016 numbers are in blue, and the 2019 numbers are in green. So as you can see, between seed, Series A, and Series B, we're seeing deal sizes double, basically in the interim. And so these are the global. So Tiger Global is of course a global operator, right? And I think it's interesting where even though we're seeing these trends on the global level and we're seeing some knock-on effects in terms of the deal sizes, Southeast Asia is still in this strange spot where basically if you look at the types of investors and where they operate, we have a lot of seed funds. There's a lot of seed players, right? And for late stage, so I say late stage, I mean like D, C, D plus, there's a plethora of options. You can IPO, you can do a SPAC, you can do an M&A, but there's actually a huge space that's left out in sort of the growth stage, like the B, C stage of funds. You can see that here, right? So this graph is showing you number of funds at each stage. And you can see that also reflected in startup survival rates by stage, right? So what I've compiled here, adjust this a bit, is basically you have two sets of data. One is startup deals in Southeast Asia between 2011 and 2021. So this is the blue line here. And then the other one is a cohort of tech deals that were done in 2011 and 2014, which is this orange line here, right? So as you can see, here are the number of deals at each stage. And then the percent previous is the percent of startups that were able to successfully raise a subsequent round of funding, both from the immediate previous phase and from the total. So how to read this essentially is what you're seeing is if you're a Series A company, the chances of you raising capital and being successful between the US and Southeast Asia they're pretty comparable. So basically 47.6% of all startups that raised a seed round went on to raise an A round in Southeast Asia, right? And in the US, that number is 55.9%. So
So
really,
when you say
really
successful, it means converting to the next stage, right?
yes, I mean, so to be clear, there are some, of course, there's some companies that either don't never have to raise again because they found a sustainable business model, or I mean, there's some other exit trajectories that are built in here that we're not talking about, right? So this is an approximation. I understand that, but I think it's a useful metrics to look at, right? But however, once we start getting to the B and C stage, we see a pretty significant gap in the survival rates, right? So in Southeast Asia, only 18% of people that raised an A, only 18% of people that raise a seed managed to raise a B, right? Whereas in US, 33% of people that raise a seed managed to raise a B. And as you go further down in the stages, those numbers, that gap starts to widen. It does, however, reconcile a little bit towards a very, very late stage, right? Where, as you can see here, once you get like the GHI rounds, right? Basically, in certain cases, like 100% of startups are raised in E round. In Southeast Asia, managed to raise an F round. But I think this is a function of just like
That's
that's like the grab, and there's so few deals here. So there's a joke here about McKinsey consultants and data points and not having enough data points. So I think but anyway, I think what I'm saying. Oh, go ahead.
How do you adjust for the definition of size of rounds from region to region? Because a seed in Asia for a long time, it's not going to be the same as a seed in America.
You
Is
just
that adjusted or no?
you just compensate for the sequence. So the first round is C, the second round is A, B, C,
just
D.
by
So
sequence.
just by
The
sequence.
sizing doesn't matter.
Yeah, because there's a bunch of like different names, like this Super Series A, Super Seed, blah blah blah.
Okay.
For just keep it simple, right? Sequentially.
All right.
Yeah. And so that's for me, that's interesting, right? So basically what it's saying to me is if you wanted to play in the space in Southeast Asia, actually being in the growth phase, I think there's some interesting potential opportunities that are there. And then, so the last part of this is what are these people actually funding, right? So this is essentially capital invested by sector in USD, broken out by year across all the different verticals, sorted in descending order. So I think it's no surprise that the two largest beneficiaries of capital over the last 7-8 years have been the consumer internet. So that's the Grab, SuperApps, and the retail. So these two,
e-commerce.
Yeah, e-commerce, right? So these guys have raised essentially over between 2013 and 2020 about $20 billion US in capital, which counts for the vast majority of the capital that's being deployed in the system. However, as the ecosystem matures, we are seeing some changes here. So, as you can see, You're seeing like upticks in payment. We're seeing uptick in fintech, financial services. We're seeing uptick in logistics. So these are what I would consider sort of like the digital infrastructure plays that are to be had in the region. And we're also seeing some nice uptick in healthcare and education. So I think that's pretty self-explanatory. Obviously, healthcare with the whole COVID situation.
Just one point. I think the charts that you're doing here, so you're showing here, came from the Central Ventures report, and we're actually sort of so co-branding this report for the Chinese audience and tailored a copy for China. So actually went very deep into this report, and I mean these guys, Central Ventures, Dimitri, Sang, and the team, they have been tracking these numbers for about 6-7 years. It's very interesting. So the retail you refer to is essentially e-commerce and anything that has to do with the people selling to consumers. But what do you see? Healthcare and education. Last year there was actually a drop. If you pay attention, so in 2019 everybody got so excited, and there's so many different startups in healthcare and education which got funded, and in 2020, I mean, which was supposed to be a year where these things just explode, but from a funding point of view, that doesn't represent. So that's something we find fairly interesting, and I think something to do with the structure of the healthcare and education system each countries. I mean, you've seen a crackdown in China about education, and of course, I mean, the sector bloomed partially because the pressure that the kids are facing, the parents are facing, in order to excel. And of course, people are saying that, okay, in Southeast Asia, I mean, the population is big, so it should be competitive. But the reality is that we don't see things as being so competitive. And many of the companies which are in education got lots of funding because they were riding on government subsidies, educational programs. So essentially became distribution channel for government subsidy.
Interesting. That's
anyway,
interesting. Okay, I did not know that. No, that's an excellent point. Thank you for bringing that up. Let me just wrap this up real quick.
Sure.
I'm almost done. So here are sort of my takeaways, having gone through these. So there's a couple things, right? So what we're seeing essentially is there's a plethora of these early stage funds. I think if you're an early stage entrepreneur, like trying to raise a seed round or a Series A round, you have a lot of options, right? So essentially that means is that most early stage capital is probably going to be undifferentiated unless you have some really strong brand name, or you're incredibly strategic, or you're some sort of domain expert, right? Other than that, it's capital is just going to be capital on the early stage. As we go a little bit further down the stack or downstream, like I said, I think the fact that there's still a fairly substantial lack of growth stage funds, I think means that a lot of these undifferentiated players can actually have a window of opportunity to deploy interesting strategies in the region. Because then again, by the time we get into late stage startups, I mean, there's so few of them, and people are so bullish on the region that they essentially have a plethora of options in terms of exits and liquidity. So you're not going to be able to play at this stage unless you have access to, like I said, like sovereign wealth money, essentially, right? Institutional. Yeah, I mean, the biggest asset allocators in the world. That's the level you need to be at to play that game. And then finally, like I said, there is a shift in investment focus. I think, of course, consumer internet will still remain a strong concentration because that competition, that game isn't played out yet. We don't have a clear winner, and I think there'll still be substantial amounts of capital being deployed into that space. But I do see we're seeing additional emphasis on at least the digital infrastructure side of things, and early numbers indicate fintech and edtech. But as Zhenggan has pointed out correctly, that 2020 did see drop off relative to 2019. So I guess my point is, if you're trying to be an early stage angel investor, you should probably really know your shit, have a really good brand, or have some really great value add. Otherwise, I think it'd be quite difficult for you to get in on some of these deals. So yeah, that's basically it. I'll stop this.
I'll just jump in because I think Dave looked at the trees, and before we dive into the leaves and the smaller details, which we'll pick apart, I don't, for my part, I don't think we need to talk about too much. But the way I looked at it was looking at the forest. And I think a lot of what we're seeing and why we're seeing this huge surge in capital in the region was because it's tied back to the 2008 financial crisis, of how QE played out and the tone that set psychologically, policy-wise, that followed which led to a huge rise in the massively inflated financial system, right? And it just kind of directly flowed with the expectations of low interest rates, all the money flowing to the market to the largest institutional investors. And I haven't done the exact math of how each step worked out, but I do think ultimately from the 2008, the low interest rate environment from 2008 to 2016, right? Everyone was taking advantage of this bull market run. All these institutional investors made so much money and they were looking for more risk capital. And all this kind of risk capital, not all of it, actually it's a tiny percentage, made it into the VC space. So what's really interesting, if you look at a percentage of VC out of the total financial market, it's tiny, which is why this leads to the rise of Tiger Global and all these kind of players who can now innovate because you have much more capital to play with. And it kind of leads to the environment we're seeing of why we have companies raising billions of dollars to buy market share, more financial engineering, people trying to fight for the same user base, and you don't need to kind of innovate on the product as much where you have so much capital just to build it and figure it out later, which kind of leads to companies we're talking about later, like Zomato, or all these kind of grabs and AirAsia. Is like, does all this make sense, because there's so much money flowing into the system, and as a percentage, it's still small. So like, it's very possible if this bull market run keeps going, like this metaphor just extends even further and gets bigger, and that ultimately does squeeze down, like Dave points out, further down to the early stage, like, why do you matter if there's so much money in the market? All the big guys are going to have information funds where, like, right now it's like maybe 10 to 50K checks is going to be the same thing as doing 100K checks in the future because it's so small relative to the size, right? So I think the psychological effects, how these LPs and institutional investors are feeling affects downstream of what we see in VC, those trends that Dave's talking about. But then maybe you guys want to pick apart, like, I don't know, do you guys kind of agree with what Dave is saying?
All right, sure, fine. First of all, Dave, thanks a bunch, man. That was an incredible presentation. I'm not sure how our podcast listeners are going to get that, but I hope that people tune on to YouTube and see that, because that was pretty cool. So a couple of things. Number one is, I think in general, there's like this, look, with investing, what you want to do is be able to own 15-20% of the winning companies, right? If you can predict Apple upfront,
The whole way.
I mean, I can't remember which VCs it was, but like, Excel, for example, sold their Apple shares in the early 90s because they had a commitment to the LPs, right? If they had held on to their shares for another 30 years, it'll probably be the size of some of the funds that they're raising right now.
So Sequoia
And
did it a few times.
Yeah, correct. So at the end of the day, ideally what you want to do is to be able to hold like a stake in the companies that have been battle tested and they're going to win, right? So this Tiger strategy is incredible. Ultimately, Tiger is one of the Tiger Cubs. After Julian Robertson wrapped up his business, all the people that were running his different investment funds ended up doing their own things. And one of those is Tiger Global Management. And at some point, the team running it figured out, hey, actually, there is make complete sense to pivot towards just doing VC. I mean, I still think they do traditional PE as well, but basically they started to bet on late stage, Series N deals, right? And what they're doing is a strategy of like, how do you predict and aim and own reasonable stakes in the companies that are going to blow up? Because it's you've almost de-risked it by coming in at that late stage, right? And at that point, the kind of valuation you're doing, the kind of work and analysis you're doing to figure out whether it's the right deal is closer to traditional PE, looking at traction, looking at consumers, looking at how that business is growing. So I think that's the first piece. So it's like, it seems obvious that PE is moving into VC and then VCs are going to this size, right? But then to just add a little bit there, I mean, everything that we're seeing right now is relatively recent, right? Anderson Horowitz's first fund was 2009. That's 12 years ago. And, that was like 12 years from software is eating the world and this whole thesis that tech is going to take over. And now they're running, 16 to 20 billion AUM. The iPhone was launched in 2007, not that long ago. And now we're seeing, the beginnings of where things are going. Then you had Masa-san with a $100 billion vision fund. And people were like, does that even make sense? What are you doing with all of this stuff? And turns out SPACs ended up playing the role that Vision Fund did as well. Like the total value of SPACs last year was somewhere close to 100 billion, which is what they were planning to do with Vision Fund 2. And then you add fractionalized ownership, secondary trading sites like Republic and EquityZen that have risen in the last few years. like there's just a lot more entry into trying to invest in tech, right? And so I think that's going to be natural, and you're just going to see more and more of these balloons. What's curious for me though, Dave, I don't know what the sources the data is, but I'd love to know what the MOIC or the returns are on some of these funds, because on average, I don't know how many people are actually beating the market and what the real alpha is, right? I know some of these funds are doing like 20+% IRR, but is that really better than a traditional any sort of other index fund? Because there are specialized funds like I was looking at the LATAM space thanks to Jangan's rabbit holes that he keeps introducing to me, and there are funds doing 40-60% IRR there. So I do think that it depends on your specific place. Some funds are doing better than others. It'll be kind of interesting to know why they're doing that. That's probably like one piece to dig deeper. The second thing is this dearth of growth stage companies, right? Growth stage VC. That's been the thesis of a couple of entrants in SEA. So if you guys remember Nick Nash, the president of C, who left in 2018, I think, and he started Asia Growth Partners, which is basically like a VC fund looking at this space. That was his thesis, and now there's a whole bunch of them that have launched in there, right? I'm very curious to understand why there is that gap, because I think my logic is like, below growth, it's all about like, is the team good, is the traction making sense, does the market exist, right? Above growth, it's traditional PE funds. Your 2x2 chart just now, Dave, of like PE moving into VC, that's traditionally the VC players who are playing these big tickets are PEs who became VCs, or VCs who think a lot like PEs, like A16Z, right? But what's happening is like that there's that middle stage where, like, I think it's a lot deeper than this, right? So if I take a stab at this, here's what it is. If you're a large fund, then your LPs are going to be pensions, endowment funds that have very strict capital requirements. They're going to need you to look at specific companies, have very strong data controls, have very strong capital requirements, right? If you're a seed stage VC, you can't raise from these pension funds because you're literally shooting darts in the dark, right? So in that sense, you're going to high net worth investors, family offices, people have exited their startups before. So your LPs are a fundamentally different bunch. I think growth capital is tricky because the guys who are writing the LPs who are writing $50 million checks, may be reluctant to give it to a growth capital guy. So I think fundraising is tricky at growth capital. I don't know enough about this space, but that's one hypothesis. The second hypothesis, I just think like analysis is super risky. So it's easy to say, like, I mean, when I look at a chart, I'm like, holy shit, let's just raise a fund and like invest in the 20 or 30 million stage. But I actually think there may be like some serious structural reasons for why they don't exist. Also, I just realized that my video screen is frozen. Is it frozen for all of you guys?
You're frozen, but your audio is clear. So
You are pretty cool, being still and still talking. So very nice.
Just really quickly, I mean, there is a comparable, like, there's a comparable to Silicon Valley, where the reason why Tiger Global exists was, I mean, part of the big picture that I was talking about, but it's because of all the growth funds in Silicon Valley were kind of getting lazy. I heard this from a few other podcasts of people talking about this, and that from like everyone funding Series B, it was just easy. Like once you cleared market on A, they would just wait and just throw all money in there. So Tiger Global was just like, well, we don't need to do all the due diligence anymore. We're just going to do it really quicker and faster. We have more money, because that's what moves it actually makes a difference on the AUM, right? You need to deploy a lot more capital for that to make sense. And there's also the argument going on now that you don't even need growth stage. There's so many more ways to finance your company if you want to get more liquidity. You just need to go C to Series A, but then you can skip it and just go be a SPAC, right? So there's that argument going on that maybe it's innovating to the point where you don't need it. And then the other argument was answering, that Tiger Global's disrupting that growth area in the middle, right? And for Southeast Asia, I'm not too sure what that means. Maybe Jagan can give better insights.
Yep. I actually wanted to comment on this part about the Series C, Series D gap. So in China, in the venture circle, there's this saying called C轮死, which means you die at Series C. And I have not seen any data supporting that, but this is something that many people talk about. And the rationale is that if you think about different series of funding, right? Seed is essentially to get ideas started. I mean, get a product and start to get some customers. And the Series A is supposedly fund a product market fit, and it can grow, it can scale. and Series B, you continue that scale. And and the thing is, I mean, I look at many of the companies in Southeast Asia. Some of them, I mean, many of them, Series A not a problem because they find a way to grow the numbers. At Series B, they can still grow the numbers. At Series C, that wild growth sort of hit a wall, saying that I can't grow as fast as before. Just think about all these companies in Indonesia doing FMCG, whether it's distribution or retail, that has been selling cigarettes, right? I mean, at some point in time, you realize that okay, you don't control anything, and it's still the upstream guys. And unless you're willing to invest in like trucks, warehouses, and to become a proper trader, otherwise, I mean, people see that your model can't grow anymore. So I do think that in Southeast Asia, I mean, at least you can see a few companies which grow until a certain stage. I mean, after Series B, they are still growing, but when Series C investors come in, they said, okay, with this money, with this check, I'm going to write to you. What else can you do? And typically, I think with many companies, this is where they struggle to find a model which deviates from, not deviates, but which extension to whatever that gave them the initial impetus for growth. I mean, if you look at companies like Zilingo, I mean, I'm sure initially the numbers looked impressive. If you look at some of the companies which just raised Series B, I'm sure the numbers look impressive, but are they able to sustain that growth to Series C and above? So that's a big question mark. And in terms of, I mean, I know Nick Nash has made argument that okay, there's a shortage of Series C to Series D, so that's why he was raising this capital, which I think having someone based in this region who understand this region to invest in this stage, it makes sense. But this is also an area which is highly competitive, right? I mean, I know lots of people coming from outside this region, sending a guy to be based in Singapore,
Yeah.
looking for deals between 30 to 80 million, 30 to 100 million, 50 to 100 million. So this is an area where people pretty much move globally. So I wouldn't think that lack of indigenous funds would make much difference. I mean, if you have companies which are still growing at that stage and they're raising capital, I'm sure that especially now Southeast Asia is in the map of global investors. So I'm sure that they can raise money from somebody from Korea, somebody from Japan, somebody from the US, or even somebody from Hong Kong. So I don't see that as a problem. Um, I think Andrew mentioned a point about the percentage of VC being very small out of total investment in this region. I remember I was talking to a state-owned company in Indonesia, which does lots of investment. That's about 2 years ago. And the term he used, I mean, part of what his allocation is VC. And he said, I mean, the VC looks very impressive. Everyone talks about that. And the amount we actually put into VC versus we put into other stuff. And he used the word cute. The amount we put to use is very cute compared to everything else. It's tiny, and maybe it will become big. But I think the question for everyone is that would that be? I mean, and all these conglomerates and stuff which have money. I mean, would they be able to make this decision to bet big before everyone else does? I mean, why would they be the first to take the risk? And can't they just ride the wave that everybody else is doing? The point about performance numbers, IRR, etc., etc. So I've seen the DPI, distribution to paid-in capital, of a few VCs. Actually, very few VCs in this region have DPI. I mean, have basically paid money back to investors. I think there are
Yeah.
there are two or three which are impressive, but the rest is like 0.7, 0.8. And I remember there was one of them which was pitching to a LP. I was actually in that meeting. He said, "Look, our DPI is 1." And the guy said, "Oh, I invested in the same. I invested in a fund in Beijing, and it has been 2 years, and the DPI is already 1, and it still has 5 years, and it still has bite downs in its portfolio, which has not exited. So, I mean, where do I put my money? So I think lots of the people who put money initially with Southeast Asia, some of them are opportunistic, but some of them are just putting some money to test the market, and only when the market truly sort of matures with lots of opportunities, they are willing to put in big money. Which I think with some companies exiting with multiple IPOs going on, potentially over the next 2 to 3 quarters, and some big money is going to come in. Two more points. Sorry, very quickly. So I actually like the way that the guys who have been, I mean, the crossover funds, right? People who have been, I mean, not only PE, but people who have been working on secondary markets going to VC. And I've been talking to lots of these guys over the past 8 months since the beginning of the year because I'm stuck. They're stuck. Um, so what I find interesting is that I mean, lots of the things that VC and especially PE guys argue over and again about due diligence, about this, about that. For them, it's like, oh, not an issue. I mean, a small issue. I've seen that with so many companies. So the way they allocate capital, the way they evaluate companies, it's different. So I have a feeling that many of the VCs looking at, or even or PEs looking at some of the issues that are not issues for the guys who are so used to secondary markets. The last thing is about due diligence. I mean, how much due diligence do you really need to do? And if due diligence gives you some red flags, what do you do, right? I mean, do you sort of just ignore it, or do you actually make a fuss out of it? And I do have a feeling that whoever who has signed a term sheet would have natural impetus to push through this deal. So I mean, if I've already made effort and to negotiate with this company, give me a term sheet, I think this company
What do you
good.
mean?
So
Yeah,
unless
what do you mean?
unless there's something drastic coming out of due diligence, otherwise, I mean, the incentive is to push through the deal. Unless there's like really a big
Just
body
give them
behind the
more
couch.
money. Sweep it under the carpet. Give them more money. Which honestly, which is I think what we've been seeing on all these big fundraisers we've been witnessing happening, right?
Yeah, because I mean, it can show some warning signs, but which warning signs should you take serious? Which warning signs should you not? And do you leave that entirely to risk, or do you make sort of subjective assessment? So that's a thing which I think people need to think about. Which strategy they want to take. How are they going to approach this?
Well, I mean, I think there's okay. Yeah, that's. I mean, there's a couple of there's a lot of points that were brought up, and I'll try and go through them a lot. I think Andrew and Chang on everyone's point about like what are the actual IRRs on some of these funds. I mean, I'll be honest. As I'm pretty sure someone's done the math on this already, but basically, I think if you were an angel investor, right, you would probably be better off financially if you just bought an index of publicly traded tech stocks and held onto those for 10 years, as opposed to actually doing to being an angel investor, right? I think like right now because of
Invalidating my life, David. You're invalidating my life. Why are you
I've been
saying these
validating my
things?
own life, so we're both in the same boat. It's not, I'm not picking on you, but let's be honest, right? Like I mean, I think I'm talking about angel now specifically, early stage in general. I think you should only do it if there's got to be some really strict criteria. Like one, if you really understand the space that they're trying to play in, or two, and probably more, is like you just want to do it just to sort of give back to the ecosystem. Because I mean, looking at the asset class in general, the returns on angel, I think is like, I think the industry average is like 20%. But given like how illiquid that asset class is and how long you have to hold it, you just buy a basket of Google, Apple, Fang, whatever, and you'll probably make about as much money, right? And you also have the upside of being able to cash out if you need the money to go buy a boat or something, right? So that's early stage.
Yeah.
On the late stage, I think that's where like Tiger is also interesting, because these guys, um, as people have pointed out, they don't necessarily have a fiduciary responsibility to disperse their gain, so they can actually hold on to the companies after they become public and write out any potential upside that's there. And I think then the question is like, okay, what about the people in the middle? And I think this is the tricky part, right? So I've been in LP meetings where VC in some ways is sort of like the cushiest of all jobs, where you raise, because you raise. So the hardest part about VC is raising your first fund. Getting someone, if you're a new entrant into the market and you've never managed money before, getting your first anchor and getting your first people to invest in you is always going to be the hardest. Because then what happens after that is you deploy on a 7-year time frame, and usually what happens is, around year 3, year 4, you start, doing talks for fund 2. But the problem there is usually your return, you're raising based off paper gains. And as we all know, in a frothy bull market, paper gains, it's really easy to show high IRR on paper gains, because you can pick and choose. So it's just the incentives in general, I think, are kind of perverse. in that sense. So, and that's sort of getting to Junggan's point about like people not having a lot of transparency in the region about what their actual like ratios are in terms of that. In terms of sort of like the red flags question, right? I think those tie together because, yeah, if the VC's incentive is to deploy capital as much as they can and then to raise based off paper gains, and yes, I get your point about looking the other way. I guess my question to you, Junggan, is like, I think that question differs a lot based off what stage you're at and what kind of red flags. I'm not sure I agree that having a term sheet in and of itself is sort of like a strong enough motivator just to push through a deal just because I have a term sheet. I mean, I've been in meetings. I've raised before as well personally. Like I've had plenty of term sheets that have fallen through after the term sheet's been signed, and something comes up in due diligence. And I like to think that I'm a pretty honest person, and I'm not like doing something egregiously wrong. So I don't think I agree with you on that point. That's
But my question to you is that, I mean, when something comes up, is the same person who signed the term sheet who turned out a deal, or is somebody else within the fund? I mean, maybe a different partner, maybe the investment committee. My point is not about fund per se. My point is about the individual who gave the term sheet would have a natural inclination to push the deal through. Not necessarily the fund as a whole. Yeah.
That's true. That's true.
Fair enough. That I agree with. Yes, in that case, yes, the person that is the point person on your deal, generally speaking, I agree, has incentives to push the deal through. I agree with you there.
Okay. Well, to me, the more interesting question, like now, given what we've talked about, and I really like this because it helps formalize what I've been feeling, right? And this is more of a personal question than to you guys. Would you prefer to be a builder in this market, or would you prefer to be an investor in this market?
I think
given what we talked about.
You asking for career advice, Alex?
I think that question is really specific in terms of what your background is, right? Like if you're a part of like this universe, and it's a very small universe of successful entrepreneurs in the region, you should definitely be a builder because you get you get the best terms, right? Like if you're the guy, hypothetically, let's say if Anthony Tan wants like quit Grab tomorrow and he went out to build another whatever, you would just get the creme de la creme of everything, and you could just take your pick of the litter and you would get the best deals ever, right? But I do think if you're just like a normal person that maybe has had some middling success, or is a fresh, I think the other side of this market is there's still a lot of information asymmetry between the investor and the entrepreneur, and I do think there are some my choice is I would be an investor, but that's just me.
Yeah. Well, you feel that you have an advantage because you've been a deep operator in the region, and you know a lot of the players in the network, so you have some kind of advantage, I guess.
That's true. Yeah, you have a roadmap. I think you have a roadmap, and I think there is more professionalization. There's more transparency into the industry. That's certainly over the last like 7, 8 years, and it's improving, right? But at the end of the day, it's still, I think, a very nascent market. Right?
I agree. Yeah, it's because it's about like there's still lacking infrastructure. Like if you look at like actual term sheets going wrong compared it to other more mature markets, there's still a gap. Like Safe is still a relatively new instrument. Yes, you see more nowadays, but like before that, it's like it's like a lot of investors don't even know what it is or don't even want to engage in it, right?
Yeah.
And the other thing is mentality. What is the investor mentality? Is founder friendly versus just I'm gonna just not help you when it comes to push to shove and not support the founder, right? And I think there's still a lot to be developed on the micro picture there. And same thing points to lawyers. Every lawyer I meet, I try to get them to convince them to be like a general counsel for startups, but it's hard to convince them. They're stuck in their lanes, I guess. But, I don't know. And Drew, has any of this data changed your mindset? Do you still want to be a builder? Do you want to invest more?
So I mean, I'm greedy. I want to have it all, right? And to be honest, like if you look at the Anthony Tans of the world, I'm pretty sure he's angel investing on his Sunday evenings, and he's getting like amazing deal flow because he's Anthony Tan, right? So theoretically, if you do build something at that scale, you will also be an angel investor, and you'll have access to incredible deals. I'm gonna maybe like I'm gonna put it this way, right? For me, investment is something you've got to do every day. It's like going to the gym. right? Every person needs to be an investor, because if your money's not working for you, then you're working for money. And it doesn't matter where you're investing. Are you investing in public markets, private markets, crypto, whatever? Find your thing and learn how to make money work for you, right? For me, I like Angel because it's fun. There's all that information that I've access to in my brain, in my network, and I can use that to do interesting things, right? And number two is I feel like I'm generally helping these companies. Like I feel I have something to contribute beyond just capital, and so in that sense, like Angel's super fun.
Yeah.
And number three, which I have not realized yet, because if you have, in many ways, right, seed investing is a ticket. You're paying for a ticket, knowing well that you'll burn it, but there's a chance that that ticket could buy you the next unicorn. And if you have the ability to add an additional to enter in additional rounds, right? I mean, nowadays it's not common to get pro rata rights anymore, but if you have good relationships with that founder, you can either get a syndicate together, do an SPV, or just put your own money in if you have that much to get into subsequent rounds. And going back to what I said earlier, the goal is to have significant, as much percentage as possible of the largest companies in the world, right? If today you could invest in the Apple of 20 years from now, right? And you know the founder close enough that you can keep staying at a 2% or 3% ownership of that company. That's incredible, right? And so in that sense, I think like, everyone's got to be an investor, whether you do it on the side or whether you do it on the full time. It's something that you got to do. Now on the kinds of funds though, I think this is where it gets really interesting, right? So two things here. Number one is, there's so many ways to skin this cat, right? Like you've got the traditional way of looking at VC. You go out, you raise funds from a bunch of LPs, you run this VC, and then the world's evolved. Now you have syndicates, you have friends that do it together over a weekend, you have single GP funds. I had calls from investors in the valley going like, you've just exited a company in Southeast Asia. Well, how about, do you have a fund? Can we co-invest with you? How does it work? And that's very interesting. Like people are actually looking out for single GP funds, because there's been huge success in the US with people who've exited their companies and then invested in fields they're very close to, right? If you're the co-founder of Kareem in the Middle East, you have access to networks that no one else has. This isn't the Silicon Valley where everyone has somewhat similar access to everything and there's a lot going on. In these regions outside of developed markets, like you can be a power broker and a communicator, right? And that goes hand in hand. This is in the public markets. You can have information that no one else has. And so in that sense, like I think investing outside of public markets, you have an informational advantage, right? Now, how you monetize this, whether you monetize it, your choice of vehicle, that's ultimately dependent on to you. You could also have all this information and then make terrible bets because you're just not very good at making bets. Entirely possible as well, right? I hope that's not my case, and I'm going to learn that. But the issue with investing is, like you mentioned, you find out that data way too late, right? And last bit for me is this, right? Correlated with what I just said, because you find out that information very late. And also, if you think about it, right, the Sharpe ratio for like any sort of tech investing, Sharpe ratio meaning your return per unit of risk, right? So your returns per unit of volatility, it's ridiculous for all these alternative asset classes, whether it's angel investing, crypto, whatever, right? At the end of the day, if you're my theory is this, right? If you have $100 million, under your name, right, you're going to put a bulk of that assets in something that's either your own business, or if you're not running your own business, you're going to put that in something that secures that money over the long run, decent returns at a relatively acceptable rate of volatility. You're not going to be throwing it and gambling and doing ridiculous bets. You'll take a small portion of that and you'll treat it like chump change and invest, right? Angel investing is like that. It's more like, it's a bit like taking punts and taking bets, right? So if you're a bit of a gambler who likes to do a little poker and you've got friends that you like playing along with it, it's a bit like that, right? But if you are relatively well-to-do LP who has funds that you're managing with some level of sanity, or if you're managing that for some, like if you're a pension fund, there's no way you're giving that money to people who are making punts. No way, right? You have a responsibility to ensure people have their pensions at the end of the day, right? a fiduciary duty, or whatever it's called. And so at the end of the day, I think like there's a room for all these vehicles, but I guess more curiously, and I feel like I'm meandering, but I'm just going to wrap it up here. I'm very curious whether the world is going to open up and allow people to invest in more stages, right? Because right now there's this whole universe of private equity capital that is untapped for by most retail investors. Even if you're somewhat accredited, it's just hard to get into the Series N of SpaceX, right? But I think there's an opportunity here to have retail investors start to access things like what Tiger's accessing right now, right? And I think actually that revolution is happening. Like if you look at the 1800s, before, I think it was the Missouri company that introduced like corporation stocks, and everyone was like, this doesn't make sense. Why would you let 2,000 people own a company, right? And today that is the predominant way of how companies are run. I hope that what's going to happen with this whole liberalization is that stage of corporatization and fractionalized ownership goes lower and lower and lower, so that more people get to access these things, and that generates like a flywheel of capital, right? But I guess that's just my very like waha rose tinted thinking.
Do you want to do a syndicate? Because I look at the syndicates now, they're pretty boring. It's like a bunch of people, each one putting like 10K, 20K, 50K. Do you want to do a syndicate where everyone puts 500,000 and it becomes like 5, 6 million?
I think if you lead a syndicate because you have information that other no if you lead a syndicate because you have information that other people don't have, then you have an information advantage, right? um, so I think that's where it works. If you're in a region where information is hard to get, um, like I think running a syndicate in the US is really hard. Everybody has access to quite a similar information unless
true.
you pick
That's
a
true.
very unique vertical. But LATAM syndicates have been really powerful, right? Middle East syndicates have been really powerful. In Southeast Asia, there's actually a dearth of syndicates. There's a few, and so far, at least the ones that I know of are doing relatively well because again, it's about deal flow and access to information, right? And the syndicate has power. But yeah, that's my take.
Let's do a crossover syndicate.
Yes, now we're talking.
Yeah.
But Andrew, you didn't answer the question. So are you building more, investing more? I know you have to invest always, but which one are you doing more?
No. So the itch to build is strong. The itch to build is strong, and I think inside I'm going to be a builder.
Okay, you're gonna be a builder.
No, my sense is
Go,
that I
Chang.
mean, you always need to be to have something that you are building, and whether it's big or small. I don't foresee myself transitioning into investing full time anytime soon because building is something which gives you a sense about how it is like. I mean, how the young people are like. I mean, how it's like managing people, working with people, etc., etc. What are the business problems that people are facing on a daily basis? And yeah, so always have something that you are building
Yeah,
and investing you can do on the side because that's not a full time job unless you manage other people's money.
correct. Next topic. Let's do it.
Next topic or wrap up?
Next topic, let's do it.
For Zomato, very specifically, the story is July 23rd. The past month, they IPO'd on the Indian Stock Exchange. They listed at 76 rupees with a 50% premium pop. It's the largest tech IPO that India has seen specifically for tech. Interesting, right? In order to do this, they had to clean up their cap table beforehand. So Ant Group was owning like 25 to 26% of the company, which was like a $660 million raise on a $3.9 billion valuation. So before the IPO, they did another equity raise of 500 million, which I think diluted them down to Ant Group down to 17%, which allowed them to IPO. I don't know the exact reasoning. They started in 2008. This is like the very early stages of Asia booming with the tech scene. Late stage guys, obviously Tiger Global's there, right? Fidelity, Dragoneer, all these other kind of big guys. Their current market cap after listing is around $13, $14 billion USD. As a comparable, DoorDash IPO, right, is DoorDash IPO'd in 2020 December, and they have a $64 billion market cap. Zomato, their largest competitor is Swiggy in India, which raised $3.7 billion, which kind of forced them into the IPO, if I understand the story correctly. It forced them to raise a lot of money and then also do IPO faster to get more liquidity. And the jury is still out, if the economics makes sense, right? COVID, they dipped down, they didn't do well, orders dropped. But as they recovered from the pandemic, average order value increased. People were ordering more for their families. And it's very similar to what we said about Grab. Will pandemic make it stick around? Will the economics be sticky? Is this really viable? Can they go further down the train and continue to increase the order values to make economics positive and really profitable? So that being said, I don't know. I guess guys who wanted to talk about Zomato, go ahead.
Yeah, you guys talk about it. You chose, so
Let me just quickly comment about Zomato or Zomato, whatever you call it. A few years ago, I was helping. I mean, that was 2017 or early 2018. I was helping a friend evaluating Swiggy, and I mean, of course, I sign a whatever NDA or whatever. We look at the whole data room and stuff. I think the unit economics. I think at that time, I can't remember whether it was positive at that time, but it looks pretty promising in the sense that the cost of labor was really really low, and as a result, I mean, you can do the calculation that once you have sufficient density, that I mean, at least unit economics will make sense. And we also look at the supply, and you guys probably know that in India that there's a severe shortage of supply of restaurants. I mean, there's just not enough restaurants for the urban population. That's why you see all the dark kitchens and stuff. I mean, coming out. But a few years down the road, and I've heard lots of complaints from some of the investors about Zomato, not really about the company's performance per se, but about the lifestyle of the founder, which we're not going into too much detail. But now it has IPO'd.
You can't say that and not go into detail.
yeah, you have to go into detail, man. Come on.
A nice house.
Give us a little bit. Give us a little bit.
Nice house. Very nice house. Very nice house.
So he comes from a wealthy family, or he's using the money from the company?
No, just a nice house. I mean, that's as much to do as I can say, and yeah. So, but anyway, so I think. I think a large tech company going for IPO is obviously a good thing for the ecosystem, because I mean, when was the last time that these companies appear in the headlines on Financial Times, right? so the last time I saw Swiggy was probably a year and a half ago. So that raises the profile. The thing that I think they went into Mumbai Stock Exchange, right? So I'm not particularly familiar with the stock market in India, but I've done a little bit of sort of communications with people there. I would see some similarities between the stock market in China and maybe Indonesia, in the sense that there's lots of hype and lots of retail investors joining the fray in recent years. So of course that pushes Zomato's price up, and I know some of their key investors sold half of their holding on the first day, as soon as they could. So I mean, and I asked one of them, I mean, how do you see it? I said, we already made some money, and the market seems to be highly hype driven. So the things that nobody could predict what's going to happen in 3 months, 6 month time, we might as well just pocket some money and leave a bit of a stake, so that it's just in case it still goes up, then we don't feel too regretting.
Yeah, I mean, I think that's what me and Dave were talking about before we all got together. Was it seems that their valuation on IPOs seems very high relative to what you saw for other players in the region or comparables, right?
Mm-hmm.
And my guess was that people are seeing this as a macro thing. China big, Meituan big, Zomato going to be big, right? So that seems like to be the case. That it's just people are looking at these two markets specifically, and they're giving it a premium, right?
Yeah, I mean, I get okay. To just add on to that point, right? I think the Meituan comparison, I think, is a very interesting comparison. So I looked a little bit into this actually prior to our call. So do you guys know what the biggest profit contribution of Meituan is? Profit, not revenue.
Profit contribution.
Yeah, out of their main
The group
out of their
buying
business
stuff?
lines.
Hotels?
No. Yeah, Chang guy.
Is it group?
Hotels, no.
Hotels.
Hotels. So hotel
Interesting.
bookings account for 23% of Meituan's revenue, but are 73 or 74% of its profits, right? Whereas food is 57% of revenue, but only 19% of profit. And they only became profitable like a year or two ago on food, right? So I think my point here is like, it's similar to the Grab question, right? Like we use food as food has to be a loss leader, for this kind of
Yeah.
business. And the only
Land and
way
expand.
that these things can grow into their valuations or justify their valuations if they start adding on these sort of tangential again super app services, which is kind of why I didn't want to talk about this topic, because I think it's the same. Thesis is the same, right? You have a core
exactly.
business that loses money, you have a lot of customers, and it's what else can you sell to these people. And actually I think it's really interesting because a lot of the global competitors have caught on to this point. So without naming any names, but if you go onto the career website of one of Zomato's biggest global competitors, these guys are hiring a ton of fintech people. So
where is this like in India or?
Well, that has to be Delivery Hero, right?
You guys, there's a limited universe of these players. You guys, it's proprietary information, so I don't want to get too much into it. But just like I said, go on to
Come on,
websites, look at the career sections.
It's all that career section.
Okay,
How is that
fine.
proprietary? I mean, yeah.
Yeah, okay, fine. It's Delivery Hero. If you go on Delivery Hero, they're hiring a bunch of like fintech developers out of Berlin, right? So I mean, they obviously have fintech aspirations. So I mean, then that's I think the same thing with
everybody wants to be a bank.
Everyone wants to be a bank, exactly. Right. So that's the thing with Zomato is so if they can build out these ancillary services on top of their food business and use their food users as acquisition channel, then it makes a lot of sense. But then it's same with AirAsia as well, right? Like, can you manage that entire process, the culture, the retention, the blah 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 blah.
Yep. Did you guys realize that C actually mentioned about Vietnam and Indonesia food delivery in their earnings call? I think yesterday or the day before yesterday. That was yesterday, right?
What was it?
What did they?
How are they doing?
What did they say? Yeah, I'm interested.
No, they mentioned about food delivery in Vietnam and Indonesia. They said they're making good progress. So I think it's the first time they're actually mentioning that in an earnings call.
I mean, it's very unique for them because they have access to that. I don't know how there's a crossover, but they have the user base from Garena days. Like, they are so well entrenched in at least Vietnam. So I mean, I don't know if there's any synergies, but they understand the market really well at least, and they have the right talent to kind of execute on it. So I would totally believe that they can make headway in Vietnam, Indonesia. I'm not too sure, but yeah.
They're already market number 1 in Indonesia. Vietnam, sorry.
Vietnam makes sense.
I mean, they also acquired a POS player in Thailand. They're using the POS tech across the region. Like this idea of vertical integration, they've been trying this out, right? And I wouldn't be surprised if they also get into travel bookings, and they have like voucher sales at the moment. So they're going to move in multiple directions. Sorry if I'm getting very fiery about this, guys. I have a personal vendetta about this idea of building super apps. It comes from a very deep place.
Basically, the reason why this is what I heard from multiple people, that the reason why Traveloka is running so fast towards IPO is that if C launches hotel booking before they go for IPO, it's gonna be tricky.
They're eating everything.
Don't have to do anything. They just need to launch.
Yeah. One more comment about the Vietnam food market, because the Vietnam food market is very interesting because for a long time they had a food market well before Foodpanda, Vietnam MMM, and then eventually that was acquired by Foodpanda later. But then even Foodpanda had trouble to survive in Vietnam. They had a local player, Foodie, which took over, which shows you like the market's very like, it's just, there's no guarantees. So it's very fascinating that how C Group is actually dominating Vietnam. Is it through subsidies or whatever? And it's a much more robust market food-wise than a lot of other markets, I say, where it's just like 1 or 2 players just come in and they stay, right? So, but anyway,
I'm exhausted.
Yeah. So should we wrap it up? We'll save the future of SaaS for another session. Look, we ended up talking about the same thing, guys. Honestly, it's like we talked about Grab in a different way.
Yeah.
Well, that's why I didn't want to talk about Zomato, right? Because I knew we would end up here again. I knew this was going to happen. All right. Anyway, it was nice to talk to everyone again. It's good to see you.
All right, guys, we're going to wrap it up now. This went for too long. Somehow we just ended up back in the circle.
Yeah.
But next week we'll pick something much more different so we don't get back in this trap.
Yeah, please cut some of this, Alex.
It's not a trap. If you look at the Communist Party, and they want to make sure that the same message gets repeated. Otherwise, people don't remember.
Okay, fine. So yeah, super app good. Monopoly, make money. Yeah.